Well, I'm here just waiting for some people to come to class. There you are. Hi, folks. Peter Lemieux here. Going to spend some time with you today about talking about life insurance provisions. Let me pull up my slides. There we go. Welcome to class, everyone. I'm Peter Lemieux with the Insurance Exam Queen. Looking forward to our class today. This is really important information that I'm going to be going over in terms of understanding life insurance. So let me just get myself situated here. This is not a small amount of information. So I'm going to have to take a significant amount of time to go over this. So stay as long as you can. If you have to go away, please come back and I'll continue on. But you know, a provision comes with the policy. I've said it before. It's like a steering wheel comes with a car. Okay. Provisions are part of the policies. And what they do is they explain to the policyholder what's going on with their policy, how the policy works in different situations, what will happen. So, what the state wants to do is they want to make sure you know your provisions. Because if you don't know your provisions, you really don't understand the way the policy works. So, the provisions really one of the most important chapters you have. And today we're just going to talk about the life insurance provisions, which actually has more in it than the health insurance provisions. And there's some overlap. So when we get to health insurance provisions, which I'm not going to do today, it's not as massive an amount of material. But today is quite a bit. And I have several slides I've selected, and I want to walk through it with you. So want you to know that the only way to communicate with me in these live classes is through the chat. You can't speak to me. Bits and Bots passed my P&C last week, going for life. Way to go. Steph, hi Peter, would like to thank you so much for your videos. I passed North Carolina Life, Health, and Long-Term Care yesterday. Steph, that's wonderful. That's really wonderful. Thanks for thinking of us to come on and give us the word. And for you other folks that are preparing, take hope from the people that come on and say what we're doing actually does work. Well, with being said, let's get started with a commercial. This is how to hear more from Peter. Hey, uh, if you want, you can go on YouTube, then to the Insurance Exam Queen. There are two buttons. One says subscribe and one says join. If you click on the join, there is an offer there. I teach all 16 chapters of life and health insurance in quite a bit of detail. And you can get all 16 videos for like $26. It's a monthly subscription. So if you don't finish it in the first month, then you would pay it again for the second month. But once you're done, you're done. This allows you to pick out any chapter you want. Fast forward, go back, freeze, take notes, and hear me explain all 16 chapters to you. So that for $26, my commercial says, this is the best deal since they invented cotton candy. Well, anyways, everybody has to have some slogan, right? Let's get started. First provision we want to talk about, ownership. The owner is the one who controls the policy. I like to say when I was in high school 120 years ago, and I had to go to gym class, there was this dude in front of us who had a whistle around his neck. Whatever he said, we had to do. That's kind of like what an insurance policy owner has. The owner has the rights. Here's a few things that the owner can do. They can name the beneficiary. They have all the rights to the policy cash value. They have the rights to all the dividends, and they can assign the ownership of the policy to someone else. So, in the extreme, so I can make my point, if I buy a policy on my son, but I own it, that means all the dividends, all the cash value are not his, they're mine. I get to choose the beneficiary. These are the things the owner can do. Um, Moving on, when we give the rights to somebody else, the word for that is an assignment. And folks, there are two assignments, absolute and collateral. Absolute is I give all the rights to the new person. Partial rights are given in a collateral assignment. So if I bought a policy on my son now grows up and he's on his own, and I think he should be responsible for the policy. I would grant an absolute assignment to my son. Now my son owns the policy, has the rights to the dividends, cash value, and can change the beneficiary, right? Collateral assignment is best understood that you might be going for a loan, and the person wanting to grant the loan would say, "What do you have for collateral?" Well, life insurance policy is a legal document, it's property, and you can say, "I got this policy," and you can assign the lender a collateral assignment. They have rights to your policy up to the amount of your debt. So if I owe the bank $10,000 and I don't make payments on the boat or the car, the bank has the right to invade my policy and take 10,000 out of my cash value. Now, they're not going to do it as long as I'm making my payments. Should I die, whatever is owed to the bank will get paid first from the death benefit. The rest goes to the beneficiary. So when we do a collateral assignment, we're getting partial ownership to someone else. That's different than an absolute assignment. Another provision is called the insuring clause. The insuring clause is the basics of the policy. When you get licensed, friends and relatives are going to say to you, "Can you look at my policy and tell me what you got?" Right on page one, you're going to refer to the insuring clause because here's what it tells you. It tells you who's insured, who's the insurance company, how much is being paid, how long is the coverage for, what's the amount of the death benefit, which is all you really need to know to be able to explain to them how their policy works. What's not in the insuring clause are things that we're going to talk about in a while, like explanation of grace period and reinstatement and things like that. That's explained other places. This one is just the basic facts of your life insurance policy represent the insuring clause. Free look period answers this question: can I get my money back? And the answer to that question is, in colloquial language, we ain't Costco. You can't bring it back anytime you want and get your money back. You got to turn the policy in during free look period. A free look period starts when the policy is delivered. Folks, that only makes sense. If you have a right to look at the policy, you have to have it in your hands. So when we deliver the policy, that starts the free look period. And can I get my money back? Now, for the test, folks, you got to know how long the free look period is in your state. Most states, it's 10 days, but your state could be different. You got to look at your state regulations and what's in your text to know exactly what it is in your state because it is a test question. How long is the free look period and when does it start? Next, we're going to talk about a grace period. I was tutoring somebody once and he didn't know the difference between a grace period and a free look. And he was a memorizer. He memorized questions and answers, but he didn't understand what it meant. The grace period is not about getting your money back, okay? It extends your coverage if you're late with payment. Think about it this way. you pay rent or you pay mortgage, and it's due on the first of the month. If you don't pay it on the first, they don't evict you on the second. You have a period of time you can make a late payment. That's all this is. If you don't make the payment on time, there's a time for you to make the payment and still maintain your coverage. So it's the time after the premiums due when you are covered. So if my premiums due on the first and I don't make it and I die on the fifth, I actually am still covered because I died during the grace period. So the question for you is, you have to know how long is the grace period in your state. Most states it's 31 days. Yeah, yours could be 30, I don't know. But as long as you make the payment within the grace period, you will maintain coverage. Another thing to remember is if the insurance company pays a claim during the grace period, they have a right to keep the premium that you owed them because insurance isn't free. So if you didn't make $1,000 payment on your $50,000 policy and you die during the grace period, they must pay that claim, but they only need to pay 49,000. They can keep your premium, okay? Because that you were supposed to pay, but they will pay the claim if a death occurs during the grace period. So, in your questions, folks, know how long the grace period is in your state. Talk about beneficiaries. Beneficiaries receive the amount of money at your death, okay? The owner, remember the owner, determines who the beneficiary is. Now, this is a tax-free benefit, life insurance, that does not go through your will. It doesn't go through probate court. We just send a check to the beneficiary. It's as simple as that. Send in a claim form, prove there's a death, and we pay the beneficiary. And that's the way it works. What complicates it only slightly is who can be beneficiary. Individuals usually are beneficiaries. You can name multiple beneficiaries. If I have 3 children and I want them to split it evenly, I can name all 3 of them. And then a proportion is paid to each one. You also can name corporations. You can name your church, you can name the Red Cross, you can name your college. It'll be a corporate name, but you name the beneficiary and they will receive the money at your death. Do not be confused. Contingent beneficiary is entitled to zero, nothing, nothing, nothing. A contingent beneficiary is not a co-beneficiary. A contingent beneficiary just stands to the side and will only receive money if all the beneficiaries are deceased. So if you named your college, it's not going to die, okay? It doesn't matter whether you name a contingent beneficiary or not, they're never going to get the money. But it's there in case the beneficiary dies so that there will at least be someone to receive the money. That would be your contingent beneficiary. If I named my 3 children, all 3 would have to be dead before the contingent beneficiary moves up. So please remember this. Contingent beneficiary gets nothing unless all the beneficiaries are dead. I want to discuss this one because it comes up just so you know it, okay? Can I name a minor as a beneficiary? Hey, you're the owner. You can do what you will, okay? But if you've got this 11-year-old daughter that you're convinced is the first person on earth that was made perfect, and you just adore her, and you want her to be the beneficiary, you can put little Sally's name on the policy. Please be aware of this. If you die while little Sally's a minor, the insurance company can't pay money to a minor. So what's going to happen is that money is going to sit there. It will earn interest, but it can't be distributed to little Sally until she becomes an age of majority in that state. Now, This will never be on the test. But if little Sally has a guardian after your death, the guardian can get at that money only by going to court and proving to a judge that the money will be used for Sally. Okay, so if you were planning on this money paying for your funeral and you named little Sally, good luck, because that money can't be distributed. So you can do minors, just understand the insurance company can't pay them. Trusts are really pretty cool. It costs some money to write a trust, but a trust, like a corporation, doesn't die. So when you die, the money goes into the trust, and then the trust distributes the money per what you said when you wrote the trust. So you can say this trust is to be paid to these 3 grandchildren after they get a college degree. And the trust won't be able to pay them until they have a college degree. So a trust is kind of like a way for the owner to control the money from the grave. You're dead, but they still got to follow your rules. You can do that with a trust. You can't do that just by naming a beneficiary. Classes, you can name a class like all my children. The more vague you get, the more things can get a little weird. If you say something like all my children and somebody shows up, remember the movie Elf? You're my dad, and I can prove it with DNA. That guy is going to get equal amounts of your insurance. So it's better to name the names of who you want. But all my children is an acceptable way to name a beneficiary. Finally, this is what we call the final beneficiary. If there are no beneficiaries around, beneficiaries, contingent beneficiaries, they're all dead and gone. In fact, I just had a case like this. A guy died and he had named his mother. Well, his mother died long before him. He was in his 70s. And that's all they had was the mother's name. She doesn't exist. So now the insurance company is forced to put the money into probate to be distributed by the state according to a will. Okay. So we as insurance agents don't like to see the estate as the beneficiary because it's time consuming. That money could be in someone's hand right away. Now we got to go through court and a judge decides who gets what. Costly and time consuming. It's what we call the final beneficiary when there's no one else around. For some reason only known to the states, they love to ask you guys about an irrevocable beneficiary. The reason I say it's weird is I've sold life insurance. I know you're going to be shocked for 52 years. And you're saying, that's impossible, Peter. You're only 45. Anyway, 52 years. Not once have I ever named an irrevocable beneficiary. Not once have I ever asked anybody if they can name an irrevocable beneficiary. Because once you name an irrevocable beneficiary, lock the door, throw away the key. You have no more control over who gets your money. It goes to that irrevocable beneficiary. If you really want to change it, you can't without getting a signature from the irrevocable beneficiary. It's even worse than that. The irrevocable beneficiary has control of the death benefit. So if it's a $100,000 policy and later on you're kind of tight on cash, you want to drop it down to 50,000, that can't happen without a signature from the irrevocable beneficiary because the state looks at it like this. That irrevocable beneficiary is supposed to get 100,000. And that's what you signed up for. You have to make sure they get it. So it's not anything that is common at all. One place it's common is on your test. You will get one question on an irrevocable beneficiary. Just remember, It requires consent of the beneficiary to change it. Now we want to talk about the incontestability clause. Folks, don't get freaked out with language, okay? Everybody here knows what it means to contest something. It's to challenge a decision. You know, if you're watching a sporting event and the coach or the manager argues with the umpire or the referee about a call, they're contesting the call. They're saying you're wrong, you need to change it. Never works. But, anyways, they do that. But that's contesting something. So, what we're talking about here is the insurance company gets a death claim. Can they ever contest a death claim? Well, of course they can. For example, if they didn't make their payments and the grace period passed, they're not going to pay that death claim. They're going to contest it. They're going to say, we got the death claim, we cannot pay it because the policy doesn't exist anymore. Okay? So this incontestability clause describes that situation. And there is a situation unique to life insurance that the insurance company cannot contest a death claim. And that happens after the first 2 years. What this says is in the first 2 years, they can deny a claim for material fraud. The insurance company can deny a claim for suicide. Now, I'm leaving out of this non-payment, okay? If you don't pay and the policy lapses, there's no policy for them to pay from, and it ceases to exist. But they, in the first 2 years, don't have to pay a claim if you lied on the application about a material fact or you take your own life. What happens in the incontestability clause, though, says after 2 years, and this on the test, the insurance company must pay for suicides and fraud. Yep, after 2 years. Charlie lies about having cancer, somehow gets away with it and gets a policy. 3 years later, he dies of cancer. The insurance company has to pay that claim because it's beyond the 2 years of contestability. You're going to get a question like that, and it'll be worded something like that. They'll give you a situation. They'll make up some phony name. Charles Smith bought a policy in 2020. Charles Smith died in 2023, taking his own life. Does the insurance company have to pay that claim? Well, it's more than 2 years. The answer is, in that case, yes. However, if Charles Smith took his life the next year, he buys it in 20, commits suicide in 21, no payment because of the 2-year clause. Whenever there's no payment for fraud or suicide, I don't think it's on the test, but just be aware of that. The insurance company is required to pay the beneficiary or the family all the money that was paid into the policy. They're not going to pay a death claim because legally the policy never existed. If it never existed, they can't keep the money. So they take the money that was given to them and give that instead. That's not on the test. It's just giving you some nerdy information. So tonight you can tell this to your little children, who of course will be very interested in knowing it. What is reinstatement? Reinstatement is restoring a policy that lapsed. Why does a policy lapse? You don't pay for it. Okay? The grace period goes by, there's no policy. And you decide you want to restore that policy. Very common in life insurance because we all know this, right? The younger you are, the lower your rates. So I bought a policy as 25. At 35, I stopped paying on the policy and it lapses. Now I decide, gee, I really need more life insurance. If I go buy a new policy, I'll pay age 35 rates. But if I can reinstate my old policy, I'll have 25-year-old rates. So a lot of people look at reinstating a lapsed policy. So here's the rules that must be followed to reinstate a lapsed policy. Number one, it's not guaranteed that you can do it. What is required is if you want to do it, the insurance company gives you a reinstatement form, you complete it, and they consider it. They can't just tell you, we don't do reinstatements anymore. Okay? They can't do that. So you can apply for a reinstatement, but they don't have to take you because the first thing that happens is you must prove your health. Plain and simple. You fill out a health questionnaire. You now reveal that you've become a diabetic and it's pretty severe. They could say to you, we're not going to reinstate you. You have to prove you're insurable. You got to apply during the maximum time. That could differ state to state. The most common one is 3 years. As long as you haven't had the policy lapse for more than 3 years, they'll consider you. Number one, prove your health. Okay? That time thing, check in your state to make sure what it is in your state. Next, you have to pay all your back payments. You can't just start paying fresh. You lapsed this a year ago, you got to give us a year's worth of premium to catch it up. And if you ever borrowed on the policy, you need to repay that loan with interest. So you got to prove your health, and it's going to cost you some money. It's money that's due because that policy has been in arrears. If you meet those requirements, the insurance company will approve your reinstatement and you get the policy all fresh and polished. It's a 10-year-old policy. It's got cash value in it because you bought it when you were 25. That's the story on reinstatement. That's what you need to know. All right. Misstatement of age. The insurance company adjusts the death benefit to the actual age. For that reason, misstatement of age is not considered fraud. Now, and I want you to think about this. This guy comes in to me to buy a life insurance policy. He knows younger people get lower rates, and he lies to me. He gives me the correct birthday, but he changes the year of birth. So instead of 40, he's suddenly 30. Here's a secret, folks. No insurance company requires that we see a birth certificate. They just take their words for it. Why would they do that? Because of what you're looking at the slide. They are not going to lose money on that deal. So he goes along paying the rates of a 30-year-old and he dies. On a death certificate, there's the actual birth date listed. And they look at that and they say, oh, he must have forgot. He's actually 40, not 30. So what do? They don't say fraud, he lied, no policy. They can't do that. They have to make a mathematical adjustment. So we take a look. He gave us $500 a year to buy a $50,000 policy. We take a look at when he bought the policy, how much insurance would $500 have bought a 40-year-old? And we find out it's $37,000. That's what they pay the beneficiary. The adjusted amount based on what he really gave us at his actual age. I call it a mathematical adjustment. Because the insurance company can make a mathematical adjustment, it's not considered fraud. Sounds like fraud to me, but they can't get out of making a payment. So consider this slide. Insured buys a $100,000 policy at 30, actual age is 40. At death, the insurance company pays what that same premium would buy a 40-year-old, and made up example is that only bought 75,000. That's the death benefit that they will pay. That's how we handle misstatement of age. So now we're going to walk through the policy provisions that are in a life insurance policy that you folks should have a walking knowledge of, okay? What is ownership? What is assignment, where you can give the ownership away? What's the free look provision? Now, Peter didn't explain entire contract until now. The entire contract is the policy and the application stapled together. When I deliver a policy, they get both. They get the entire contract. They'll never ask you why it is. Just know the entire contract includes the application. That's all you got to know. Now I'm going to tell you something you don't need to know. If the insurance company says we're not going to pay the claim because of fraud, proof of fraud is always in a signed application. You lied about something important and then you sign the application. It's right. That proof has been in your hands since the day the agent delivered it to you. It's not on the test, but that's why the entire contract. Um, yes, it does. Meow. That's an unusual name. Did your parents not like you? Yes, it does. Don't pay any attention to the man behind the curtain. You guys ever see The Wizard of Oz? Don't pay attention to the man behind the curtain. Payment of premiums. Folks, that's pretty simple. You, your premiums are due, you're required to pay the premiums. And if you don't, go to number 7. Then you can apply for reinstatement. Grace period also has to do with payment of premiums in that you are still covered during a grace period. All of this is explained for our clients in their policy provisions. We know about misstatement of age, incontestability, 2 years. After 2 years, the insurance company must pay the claim unless you lapse the policy. If there's a policy, they got to pay it. We are going to talk about policy settlements in a little bit. I just want you to know this. If we're settling a policy, somebody died, okay? And what are common exclusions in life insurance? So talk about exclusions first. It's common that insurance companies don't cover pilots of airplanes while they're flying the plane. In other words, we'll cover if you die of heart attack or cancer, but if you crash your plane, no soup for you. Okay? That's a common exclusion. We can exclude similarly dangerous occupations or hobbies. Okay? We're going to cover you, but you jump out of airplanes as a hobby. And if you die jumping out of an airplane, we're not going to pay that claim. Now, I'm not saying they always do that, but these are things insurance companies can do. All right? War. Deaths caused by war can be excluded. Okay? Now, this triggers all kinds of possible interesting conversations that we could, if we had a fresh pot of coffee, we could sit down and talk about them. None of them are on the test. Okay? None of them are on the test. Technically, the insurance companies don't have to pay death of somebody who died at war. I know most of them do, but technically, that's written in there if there was like a huge amount of people got killed and paying all those claims would jeopardize the insurance company. They've kind of got that out clause. But again, is that on the test? Not at all. Let me just tell you a quick story about aviation exclusions, and this kind of goes for a lot of exclusions. I insured a young lady. Now, when you're as old as me, everybody's young. So she could have been 60. But, anyways, I insured this young lady. And at the end of the application, we asked this question, and she says, "Oh, yeah, I fly an airplane. Tell me about that. I have a license and I do it as a hobby. Once a month, I go to the airport, I rent a plane, and I just fly around and I enjoy it." Well, honey, you got to fill out an aviation questionnaire because the insurance company is going to want to know about that. What kind of license do you have? How many hours do you have flying, et cetera, et cetera. They came back with the decision that we're not going to cover you while you fly that plane unless you pay an extra payment to cover you in the plane. Well, the payment was a lot of money. And she said, the heck with that. So she signed a waiver that said, I know I'm not covered if I crash while piloting a plane. She had to be piloting it. So she had an aviation exclusion on her policy because she didn't want to pay the extra premium. That's kind of how this thing works. Okay. Practice questions. Let's have a little fun with this. I put in a few of these to see how much you remember. Put your answer in the chat box. Okay. Charlie, how come everybody I talk about is named Charlie? Applies for a policy on May 1st. It's approved on May 15th. Agent delivers it on June 3rd. When does the free look start? May 1, May 15, June 3rd, or free look is extended to 10 days because the policy was delivered late. Which of those is the correct answer? When does the free look start? And the class says, I'm looking in the chat box, and everyone can't wait to answer the question. Don't break your arms typing out your answers. Diamond is the first one in with a C. Diamond is competing for the one jelly donut I have left to give away. Anybody else? Going once? Going twice? Nikki comes in. But you both gave the same answer. Now, meow, June 5th is not an answer. I know you meant June 3rd. Okay? It is June 3rd. The policy has to be delivered, not June 3rd is when I deliver it. Okay? May 15th is when it was approved, but you have to deliver it for the free look to start. So you guys got it right. And I'll send you your test grade at the end of class and you can get your license because you answered one question correctly. Next question. Mildred lies about having cancer. Terrible. And gets approved for a $150,000 policy. 3 years later, she dies. Claim is denied for fraud. Insurance is paid, but the insurer can sue to redeem the payment. Payments reduced by 50% for fraud. Full payment must be paid. Okay, folks, you're sitting in the claims department of the insurance policy. What do you do with this claim from Mildred's family? Ryan says, suck it up and pay the whole claim. Diamond says the same thing. Meow. You guys just like giving money away, huh? But you're right. It happened after 2 years, so it doesn't matter. We got to pay that claim. How about another one? Provision of consideration. Oh, it's always nice to throw a question in I haven't taught you yet, just to see how quick you are in your feet. Provision of consideration. The insurer must pay the claim in all situations. Does not apply to death claims. Irrelevant once the policy is approved. Premiums must be paid. Which of those answers makes sense to you? A, B, C, or D? I like this question because you got to think about what you know about consideration and things like that. Meow is coming in with D. What else we got? Anybody else? I've never thrown a person out of class for getting a wrong answer. I have thrown them out for swearing at me. No, I'm just joking. Okay, I've got two people who say D. Let me show you something. D's the correct answer, but follow me on this. When you get a question that you've never heard of before, there are little tricks you can use to find the right answer. Now, premium of consideration. The right answer is, if you remember, consideration is the client, the insured must pay their premiums and the insurance company must pay claims. That's consideration. But if you forgot that, insurer must pay claim in all situations. Okay, folks, that's a wrong answer because of the word all. The insured doesn't pay claims in all situations, right? We know that. Fraud, suicide in the first 2 years, if you lapse the policy, they don't pay it in all situations. A is impossible. B does not apply to death claims. That doesn't make any sense. This is a life insurance policy. Everything's about death claims. So that also is a garbage. We can't do B. Irrelevant once the policy is approved. Why would something like consideration suddenly become irrelevant? Those three are highly suspicious. But what we know about consideration is the insured must pay their premiums. So that's how I figure this out and eliminate. I have to teach a whole class on this. Eliminate answers that can't be right. Increases your chances of getting the correct answer. Well, folks, this is not the end of class. So don't go running off, turning on Netflix or whatever you want to do tonight. This is a commercial. Imagine that I've hired all these rockettes and dancers and music, and they come out dancing, and they tell you that if you go to YouTube and you go on the Insurance Exam Queen, click on the join button and get a tremendous deal from Peter. For $26, you get all the classes. So that's a commercial. So that's unashamed commercial. All right. Let's see if we can get back to business. I want to talk about policy loans. First of all, remember this, and I know you all will. You can't borrow money unless there's cash value. So that means there are no policy loans on term insurance. Got that one. Okay. The loan amount cannot be more than the cash value. Okay. And whenever you take a loan, you lower the death benefit. So let me just pick on Rachel Rogers. Rachel Rogers has a $50,000 policy. She takes out a $10,000 loan to go and put money down on a car. Sad story. A few days later, Rachel gets called home by the Lord. Okay, that's a nice way of saying she toes up. She's not with us anymore. The insurance company will pay her family $40,000, $50,000, but she took out a $10,000 loan. So that reduces the death benefit by the amount of the loan. Now, this is something that may be one question on your test. APL is an automatic premium loan. What happens on an automatic premium loan is the insured just tells the insurance company they want it, and they get it. They just put it in writing on the application or later, put an automatic premium loan on my policy. And so what happens is, if they don't pay their premium and it gets right to the end of the grace period before it lapses, on midnight of the last day, the insurance company takes out a loan to pay that premium. So the policy keeps going. It prevents unintentional lapse. The insured has to initiate this, and the insurance company honors it immediately. So I make up this story. You decide to go to Italy for 3 months. Oh, that's nice. During that time, the bill for your insurance comes in, but it doesn't get forwarded to you. Grace period goes by, you lose your life insurance, and you don't even know it happened. If you had an APL on the policy, that couldn't happen. The premium would get paid by a loan. Now, it requires that your policy has cash value in it, right? Because if it has no cash value, they can't pay the loan. So it won't work on term insurance or on brand new policies. But that's how these work. Rachel, it was my absolute honor to pick on you. Now I want to describe something else. This is called a partial surrender. You may have read about it. You guys may already know it, but I want to explain to you how this works. Let's since Rachel likes being called on, we're going to pick on her. Only this time, Rachel, we're going to keep you alive. Okay, so that's better. Rachel has this $50,000 policy with 10,000 of cash. She decides she really doesn't need that much insurance. She doesn't want to pay that bill anymore. So she decides to do a partial surrender. She doesn't want to cash out the whole policy. She wants to keep life insurance. So she says, change the 50,000 to a $25,000 policy. Well, she has the rights to do that. That'll cut her payment about in half. But when she does that, that $25,000 policy can't hold 10,000 of cash. It has to be cut in half also. So cash value goes down to 5,000. That extra 5,000 is her money. So by making this change, she lowers her payments and gets a check in the mail for the $5,000. That's a partial surrender. I think I got a slide that explains that. Only bigger numbers. $100,000 death benefit, 30,000 of cash value. Reduced to 50,000 with a cash value of 15,000. The insured will get the difference paid to them, which be a check for 15,000 because they took 15,000 out of the cash. So in a partial surrender, you lower your policy, lower your payments, your beneficiary is going to get less money, and any extra cash value exist will get paid to you. Well, that's nice to know, Rachel. I like hanging around positive people. I got this slide here. I'll tell you guys a secret. Melissa told me to take this out, and her reasoning's quite good. It's never on the test. So if you want to go get a peanut butter sandwich on this slide, okay. Besides a loan, there is a policy called a universal life that allows you to take a withdrawal instead of a loan. In other words, you just take money out of your cash value. Because it's no loan, no interest is due, and your death benefit stays the same. It doesn't lower the death benefit. It does lower your cash value amount. Now, you're in a universal life, the insurance company takes money out of your cash value to keep you insured. If that pot of money gets too low, you could lapse your policy. So only on a universal life can you take a withdrawal. On any other policy, you can take loans. You can take a loan on a universal life also, but seems like withdrawals are never asked. So we're going to just move on. Only on a universal life. If the insured has 10,000 cash value and they take a 5,000 withdrawal, now their cash value's 5,000 instead of 10. However, they don't have a loan repayment to make. They don't owe interest on the loan, and the insurance company keeps the death benefit right where it was. Okay, so again, in all her wisdom, Melissa says this won't be on your test. Next, we have to talk about disability riders. Okay, everybody calm down. Peter's been throwing a lot of junk at me, and I'm getting an Excedrin headache. A rider is something you would add to your policy. You usually have to pay for a rider. I always describe a rider like when you go to a pizza shop, you get a cheese pizza. But if you want anything on top of it, you got to pay for the extra items. That's a rider. Okay, if you want the rider, you pay for it. Now I'm going to go through 5 disability riders. Don't freak out. If you read the name, it'll tell you what it does. The waiver of premium waives the whole premium. Now you have to be disabled for 6 months to qualify. If you're still disabled after 6 months, the 6 months of payments that you made get returned to you, and the insurance company pays your premiums going forward until you are well and can go back to work. So basically, a waiver of premium waives your premium. You don't have to pay the premium. And that's what it does. Now, this particular benefit, whether you understand this or not, hopefully you do, It works wonderfully on a whole life policy because when I waive the whole premium, not only do you keep your insurance, but your cash value grows also without making a payment. So it keeps your life insurance in force and your cash value grows. That's kind of like if someone paid into your 401k when you weren't working. It's a nice benefit to put on a whole life policy, and we're going to remember it that it pays the whole premium. You just got to be disabled for 6 months to get it started. Next, there is waiver of cost of insurance. This one goes with a universal life. You don't need to know what I'm telling you now because no one on the test is going to ask you to explain anything. Teachers have to explain, you don't. They're going to give you a question, they're going to give you the right answer with three bogus things, and you just got to discover which is right. No one's going to ask you to explain anything. But the way the waiver of cost of insurance works is they don't pay your whole premium. This actually works for a universal life. Hopefully, what I'm saying here is going to make some sense to you. The major feature of a universal life is it's a flexible premium policy, which means you can change your payments. So the insurance company can't really waive your premium because they don't know what premium you're going to want to pay. Okay. So instead, what they do is they stop taking money out of your cash value to keep you insured. Every month, the insurance company takes money out of your cash value to keep your insurance going on a universal life. It's like having a bucket of money with a hole at the bottom. They plug that hole. So you're not going to lose any money, but they're not going to put any in. It's the waiver of the cost of insurance. Okay. All they're doing is they're not going to take any money out of your bucket of money, but they're not going to put it in like they did in a whole life. Now, waiver of cost of insurance only waives the insurance charge on your universal life. No money is deposited into the cash value. So your cash value is not going to grow. It's just not going to shrink, and you're going to keep your insurance. Now there's another one that's really similar. Waiver of monthly deductions. In this one, the insurance company doesn't take out your insurance. There's also a small administrative fee in a universal life. It's a few bucks a month. Anybody who handles other people's money always says some kind of admin fee. You might have it on your checking or savings accounts, but whatever. They're going to take money out of your cash value for administration. If you take waiver of monthly deductions, it's going to shut off everything, the insurance and the admin fees. Waiver of insurance only stops the withdrawal of insurance. This one shuts the loss of money more tightly. It's just a subtle difference, and it's never asked on the test. But both waiver of insurance and waiver of monthly deductions apply to a universal life policy. They can't waive the whole premium because they don't know what it is, but they'll stop taking money out of your bucket of cash. First two, I think, are a little easy to understand. A pay-or benefit is for juvenile policies. In other words, we're going to buy a policy on a child. Well, getting a disability waiver on a child, it doesn't make any sense. The child's not paying the premium anyway. Okay. So if they get disabled or not, it kind of irrelevant. What we're going to do is going to put the disability waiver. Remember, number one, waiver of premium. Only we're not going to put it on the insured. We're going to put it on the payor. Mom, dad, grandpa, grandma, who's ever paying for it. What we would do is insure that person. If that person gets disabled or dies, we don't have to pay on junior's policy until they reach the age of majority, which could be 18 in some states, some are 16, 21. But until they're declared an adult, we don't have to pay the premium because the payor got disabled or died. So we use a payor benefit on a child's policy. If you only remember that, you'll be fine, okay? Payor benefit, juvenile policies. Now, this is the fifth. I told you there's five. You'll know them by what their name is. The name tells you waiver of premium, waiver of cost of insurance, payor benefit. Now we're going to get disability income. If you people are studying health insurance, you know that there is a policy, a health insurance policy called disability income. So if you can't go to work because you got sick or injured in an accident and you can't make money, this policy pays you money. It gives you income. Therefore, disability income. Now, what we're going to do here is we're going to take that disability income policy and sew it on top of your life insurance policy so that if you get disabled, they don't waive the premium, they actually give you income, extra income. You're going to take that health policy and sew it on top of your life policy so you have income coming in. Now, that's going to be by far the most expensive of all the other options because not only are we're actually going to give you extra money for being disabled, okay? But you can do that. That's the fifth disability. So the five, don't memorize them. Don't spend time at night memorizing them. Read the name, and that should direct you to the correct answer. Just read the name of the provision. Here are the five. If you want a picture of the slide, waiver of premium, remember that works good in a whole life. Cost of insurance, monthly deductions, those are for universal life. Payor benefit for children's policies, and disability income takes a health insurance policy and sews it on top of your life policy. That's what I have to say, and I'm sticking to it. Practice question. Joanne has a $200,000 life insurance policy and takes out a $30,000 loan. She dies 1 year later without repaying any of the loan. What's her payout? 170, 200, less than 170, 0. What do you guys think? It's a trick question. It's a trick question. Because sometimes they ask trick questions. So Ryan, Nikki, following all the rules, you would be correct, but it's a trick question. So A is slightly off. Anybody figured that out? Now everyone's intimidated. How can you be scared of me? I'm just an old dude losing his hair. Anyway, here's the deal. She did not repay any of the loan for over a year. What do we know about loans? They generate interest. So when she dies, they owe more than 30,000 because there was interest, making C the correct answer. Going to get less than 170. She didn't pay any interest. Very trick question. But I want you to be aware of that. The loan just doesn't stay flat. If you're not going to repay the loan, it's going to get bigger and bigger and bigger with interest. So if you borrowed 30,000 and never paid anything on it, 5 years from now, you might owe 34,000 because of the interest. Okay. Now, is this a big deal? Everything in life is a big deal. No, it's not likely question either. But I just wanted to once in a while throw in a little trick. The key to that one is she dies 1 year later without repaying any of the loan. Oh, so it's going to be more than 30,000 that she owes because of interest. How about this one? The insured's a 35-year-old male. He has a 4-year-old whole life policy for 300,000 with a cash value of 5,200. he dies 5 days after his only beneficiary died. What happens to the death benefit misspelled? Since there's no beneficiary, it's subject to income tax. It gets distributed by probate judge. It gets paid to the beneficiary's spouse. It gets paid to the closest relative. Wow. The right answer isn't in there. The right answer is it would go to the contingent beneficiary. But what must be happening here is there isn't a contingent beneficiary. So what happens? What do you think? Isn't this fun to pretend you're going to just write big checks to people and you decide how much to write? Ryan thinks it's going to go to the beneficiary's spouse. What do all the rest of you scholars think? Diamond says A, subject to income tax. Melissa, thank you. I got 3 different answers. I like this. It gets distributed by a probate judge. Nikki says probate judge. All right, I won't make you guys suffer anymore. It has to go to probate. We have a beneficiary who doesn't exist. We don't pay their relatives. We don't pay relatives beneficiaries not listed on the policy. Okay. Income tax, forget it. Life insurance proceeds are income tax free. There's nothing you can do to make them taxable. So what happens is we don't have anybody to pay. Like my friend who died and his mother was the beneficiary, it's going to go into the will and distributed by probate court. That's the answer. And I'm sticking to it. The insured wants to reinstate a lapsed policy that's been lapsed for 2 years. Glory be. They must do all of these except pay back premiums, tell the agents, prove good health, pay back loans. Which of those is not necessary? It's an except question. Ryan, they don't have to tell the agent. Anybody else? Diamond agrees. Nikki B. Well, 3 must be true, right? If 3 say it, that's correct. What we do know is you do have to pay back premiums. You have to prove your health. And if you have loans, you got to pay those back also. A, C, and D are all correct, revealing to us the correct answer is you do need to tell them. Now we'll talk about riders. Remember riders, you paid to get them? That you can insure other people on your policy. And there's 3 of them to discuss. They're relatively simple. I can insure my spouse with a term insurance. It's called spousal term. Instead of having to buy a brand new policy on the lovely Mrs. Lemieux, I can take and buy a spousal term policy, death benefit only, no cash value. The term goes to age 65. So if you want to insure your spouse with term insurance to age 65, you buy a spousal term rider. It increases your price. It insures your spouse. You don't have to buy a second policy, but it doesn't increase your cash because it's just term insurance. So it's a simple way to get insurance on your spouse and not have 2 policies. You can do the same thing with your children by adding a children's term rider. The children's term rider is a little different. The children's term rider covers all your children for one price. So you pay the same price if you have 1 child or 21. Same price. $5 a month. Covers all your children. You have babies in the future, they're covered automatically. It covers them till they're 18 for, funeral expenses or something like that. They don't get their own policies. It's just temporary term policies until they're 18. And you can know that, God forbid, if a tragedy happens, you'll have money to help with the funerals. You can cover them all with a children's term policy. Third, you can buy a family term. All family term is spousal term plus children's term equals a family term. So I can insure several people on my policy without having to buy policies for everyone. Now, they only get term insurance, and what they do is they insure them and charge the extra premium on my bill. That's how the whole works. Spousal term covers your spouse to age 65. It's added to the premium. Children's term, all children covered with term insurance until 18 or 21, depending on your state. All are covered for the same amount with an unchanging premium. And the third one is family term, where you add the spousal term and children's term together. These are riders to cover additional people without having to buy extra insurance. Now, this is a new one. This is a different slide. Told you there's a lot of information. They keep saying, how long can this guy talk? Do you know that once, this is incredible, you people are all too young to know this, Fidel Castro gave a speech to his Congress for 8 hours? I'm going to try to beat that with this. No, forget it. Just kind of see if you're paying attention. These are riders that can change your death benefit. If you have an accidental death rider, it will pay extra if you die in an accident. If you have guaranteed insurability, it guarantees that you can buy insurance in the future without ever answering health questions. You could have cancer and still get policies. You can get a return of premium rider where at death, your family gets the death benefit plus all your money back. And you can just buy extra term insurance and put it on top of your whole life. So let's look at each of these, try to explain them. Accidental death is actually a health insurance policy. How's that, Peter? Life insurance pays when you die. This policy doesn't. You have to die the right way to get this benefit. You must die in an accident within 90 days of the accident. That's the rules on accidental death. Crash your car into a tree, you're in a coma. After 100 days, no brain waves, they decide to pull the plug. Payment, zero. It was an accidental death. Yeah, but you didn't meet the 90 days. So it only pays in certain circumstances. It's not very expensive, but if you died in an accident, it would give additional death benefit to your family, right? Guaranteed insurability, you pay extra money when you buy the policy for a promise. You don't get any more insurance or any more cash. You have a promise. The promise is that you can buy more death benefit without proving your health. There's periodic offers. Different insurance companies rate this different, but it could be like every 3 years, we'll offer you more insurance. And if you want it, you just say yes. You'll also get an offer when you get married or have a child, birth or adoption. Okay. You can then increase your insurance. You tell them how much you want to be the offer to be for. I'd like to get $50,000 options. Okay. You pay for that upfront, even though you don't have the insurance. But you're 30 now, 5 years from now, you get married. You can have an extra 25,000, is that what I said, of life insurance by merely saying, I want it. You don't have to answer any health questions. You could have stage 4 cancer. You'll get the policy at standard rates. Okay. But you will pay your new age. You bought this at 30, you take the option at 35. The new amount will be rated as a 35-year-old. So what you do with guaranteed insurability, look at the words. You guarantee that you will be insurable in the future. You can't get denied. That's what you're paying for. Return of premium, I think, is even simpler to understand. You pay extra money so that when you die, your family, your beneficiary will get the death benefit plus all the money you paid returned to you. but you pay for that. It's not free. And a term rider, try to explain it this way. You guys should all know the term is less expensive than whole life. So I just had a client that wanted to do this, wanted $500,000 of insurance, could not afford $500,000 of whole life. But we worked on the budget, and it seems like he could have have afford 100,000. So then what we did is we bought 400,000 of 10-year term, which was pretty inexpensive, and he could do both. What's the deal? You got $500,000 of death benefit by taking some of it as term insurance. So you can actually put term insurance on top of your whole life. Remember I told you you can sew a policy on top of a policy? That's what you do with a term rider. Accelerated living benefit. There's one question you'll see on the test about it. Accelerated living benefit comes on most policies that are sold today at no charge. What it does, it is allows our insureds to get an advance on their death benefit in certain circumstances. And let's take a look at what we're talking about here. Terminal illness, you get put in an institution like a nursing home or something like that, or you can't do activities of daily living. If you people have studied long-term care, you'll know what that means. But most commonly, the one they're looking for is number one. You're going to die. You get a letter from the doctor saying you're going to die. You got a $100,000 death benefit with an accelerated living benefit, which will allow you to take an advance on that 100,000. Well, there's things you want to get done that's going to cost money. You can take, let's just use an example of 50,000. You can get $50,000 out on an accelerated living benefit, tax-free because it's actually a death benefit, but it's an advance. So if you take 50,000 out, when you finally die, the family only has 50,000 left. But actually, this is not a bad idea. If you have to go in a nursing home for a while and you don't have the money to pay that, you could pay for it with your accelerated living benefit because you're in an institution. Accelerating living benefit is an advance, not a loan. It's not from your cash value. It's an advance on your death benefit, triggered usually by a terminal illness. It may be a question test. Speaking of long-term care, that's a health insurance policy. I teach a whole class on it, so I can't do it justice in a slide or two. A long-term care policy pays for it's a health insurance policy. It pays for non-medical expenses. What are you talking about, Peter? It's usually with old people, right? If you have to go in a nursing home, that's not medical. They don't do exams, surgeries, anything like that. What they do is they feed you, make sure you have a clean room, right? They make sure you take your prescriptions, and they just take care of you because you can't take care of yourself. Medicare or your health insurance is not going to pay for that because it's not medical. You need to buy a long-term care rider. You need to buy long-term care. But what you can do is with a long-term care rider is this is another sewing principle. I can buy a long-term care policy and sew it on top of my life insurance, and it becomes a long-term care rider. So I've got long-term care as part of my life insurance. Let's see, Jake Bubblegum. I have my life and health exam tomorrow, and I'm getting all the numbers mixed up 10, 20, 30, 41, hike. Any way to help me keep them straight? I have a great idea for you, Jake. I just don't know if I'm going to give you enough time. Jake, I'm going to get back to you right at the end. Let me see if I can help these other people. I'm not going to evade your question. Ooh, you know what? It's going to be easier, Jake, if I answer it with numbers. The only way to learn the numbers, you got to memorize them. I mean, I hate to say that. I had 3 sons who acted for parts of their life. How an actor memorizes their lines is a simple procedure which I advise you. Write them on flashcards. Question on one side, answer on the other side. And look at them a lot. What works better is to say them out loud a lot. Now, your test is tomorrow, so I haven't given you much time. But with numbers and other things I had a hard time learning, I put them on flashcards. And I read those flashcards out loud to engage more senses, my sight and my hearing, okay, and speaking. Stack of flashcards that thick took me about 6 or 7 minutes to read out loud. The more you read them out loud, the easier it makes sense. So my answer is not helpful for you taking the test tomorrow, but you need to put them down in writing and then read them out loud over and over and over again. So I'm sorry, I don't have a pill you can take to make it come faster. Um, this is for everyone. I can say the Pledge of Allegiance because when I was a little kid 250 years ago, we started every class by saying, I pledge allegiance to the flag of the United States of America and to the republic for which it stands. You say that every day for 12 years. I'll never forget it, you know? So when I got dementia and I can't remember my name, I'll still say the Pledge of Allegiance. You say it over and over and over again. With things that have to be memorized, that's really the advice I have. Um, what is a non-forfeiture option? Um, I find some people freak out when they see words they're not familiar with. Don't do that. Don't do that. Everybody in this class knows what it means to forfeit. It means to give up. So use a non-forfeiture option when you're not going to make any more payments on your whole life policy. Because there's something in this policy you cannot give up because it's legally yours, not the insurance companies. And that is your cash value. That's legally your money. So I don't want my $100,000 policy anymore, but it's got 30,000 of cash. You have 3 options of what to do with that cash. And the first one, 99% of the people do. Just cash it out. Send me a check for 30,000. That's number 1, cash value. You also can take that cash if you don't want the cash and turn it into either extended term or reduced paid up insurance. Nah, 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 nah. Peter, you've talked long enough that all I'm hearing is nah, nah, nah. Remember Charlie Brown? Nah, 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 nah. So I'm going to try to slow it down and make sense of it. Policy is terminated and the insurance receives the cash value minus any loans and interest. Once a policy is surrendered for cash, you can't reinstate it. It's erased from the memory bank. It's gone. That's the most common one, cash value. Number 2, extended term. My advice to you, my friends, is focus on the first word, extended. We're going to take your death benefit and we're going to extend it out. You ever have a tape measure? You can pull it out, extend it. It's the default option. If you forget to ask for your cash value, the insurance company will automatically put you on extended term. What happens is they take that cash value, that $30,000, and they buy a term life insurance policy for you for the same amount of death benefit you've been carrying. So if you have a $100,000 policy, you're going to now have $100,000 of term insurance. You're not going to make any payments. Your cash value is making those payments. Now, what do we know about term insurance? If you die, it's great. It's going to pay the whole amount to your beneficiary, but it will run out. All term ends at some date in the future. The more cash you have, the longer it can last. But there is some date in the future when that policy will not exist and your cash will have been spent. That's extending your death benefit as term insurance. The last one, oh, here's an extended term. $100,000 whole life on extended term has a $100,000 death benefit, but the policy is going to end and when the cash runs out. So we know what cash value is. They just send you the cash value. Or we can keep you covered for the death benefit and we'll extend it until you run out of money. Option number 3 is reduced paid up. Once again, my friends, extended and reduced are two different words. They mean different things. Extended extends your death benefit. Reduces your death benefit. So you're not going to have 100,000. You're going to have less. The difference is it's going to be a fully paid up whole life, which means you will have a death benefit whenever you die. If you're 99 and die, there's still a death benefit for you. It's just not 100,000. They reduce it so that it can last your whole life. Here's the choice. Stay at 100 and it'll run out, or take it down. They'll tell you how much based on your cash value and your age, and they'll say, here's 35,000 that will pay whenever you're dead. Again, remember this. Cash values used most of the time, so they're not going to ask you about it. They're going to ask you about extended term and reduced paid up. And you're going to get it right by just focusing on the first word. Extended extends your death benefit, but it runs out. Reduced lowers your death benefit so that it can last until the day you die. Those are the 3 non-forfeiture options. Reduced paid up, you have $100,000, it gets reduced, and that smaller amount stays in force until you die. Non-forfeiture options are 3: cash value, extended term, and reduced paid up. Now, if you thought class is done, you're not, because this is a long chapter. So refresh yourself. I haven't got that much left, but they're important, I feel. We want to talk about dividend options. Let's put those. Well, that's nice to hear, Tiffany. You and Jake Bubblegum going to go past tomorrow. First of all, let's try to not get too confused here. Only certain life insurance policies even pay dividends. You have to have a life insurance policy from a mutual company, or you're not going to get dividends anyways. But those that do, when you get a dividend declared, you have 6 ways to take the dividend. And the way Melissa and I do this is we set these up so that the first letters spell the really great word of crapo, CRAPPO. Okay? First one, cash. Okay, I got a $100 dividend, send it to me. There's no taxes on a dividend. I'll just play with it. Or I can use it to lower my payments. Those 2 are easy to understand. Third one, which nobody takes, by the way, is the insurance company keeps it, puts it in a little account, and pays you interest. It's like having a savings account with the insurance company. You can get paid up additions. This one is the most popular. It may be the hardest to understand, but I've got slides, okay? You can get paid up insurance, or you can get 1-year term. Let's look at the slides. Please be patient with me. Try to take notes. Cash, we know what that is. Reduce your premium, we know what that is. Accumulated interest, you just have a savings account with the insurance company. Now we get to paid up additions. Please look at the word paid up. What they're going to do is they're going to take your dividend and they're going to buy a whole life policy with a single payment. So you don't have to pay anymore. It's paid up. It's not going to be a very big policy if you have a $100 dividend. It might be like a $200 life insurance policy. But the advantage is it's additional death benefit, which will have $200 of cash when you're 100, and you don't have to pay on it. It's all paid for, fully paid up. Now, that doesn't sound like much of a deal, but what happens when you look at it over the years and every year you're buying more paid up policies. What happens is you look ahead 10 or 20 years and your death benefit has gotten significantly larger and your cash value has gotten larger, but you still make the same payment. That's been paid off with these dividends. It's a very attractive feature. Just try to remember it's paid up and it is additional. Dividend makes a payment to the policy, has the effect, this is paid up, what's this one? Paid up additions. We had additional insurance. Then we have this other one that just says paid up insurance. You're not going to get any more insurance. What they do with your dividend is they pay your payment ahead. Like maybe your dividend will pay 1 month of next year's payment. So if your payments are due April 1st, next year they won't be due till May 1st. They pay it ahead. No additions. This is also hardly ever done. The word additions is what you got to remember. You get an additional insurance. This one, they're just paying you ahead. So next year's due date is a little later. And finally, the last one is they can buy 1 year of term insurance. So if you're going to die in the next 12 months, it's a really good deal. However, 12 months later, you have nothing and your dividend's gone. Crapo, dividend options, paid up additions, the most common. I don't think there's a lot of questions on this. First of all, don't be confused. You have to have a mutual policy to even get a dividend. And the question is, how am I going to use those dividends? So the last set of options, I've had non-forfeiture options if you want to cash out your whole life. I've got dividend options, and now I've got settlement options. I told you before, settlement option occurs when someone dies. So it's a choice the beneficiary is going to make. They tell you the insured can make it. They don't. They let the beneficiary take the money the way they want. So how do you want the check? So we pick on somebody new. Well, Tiffany, you just got here. I'll pick on you. Tiffany, your great aunt left you as the beneficiary of insurance and you got $50,000. How do you want to take the money? Odds are Tiffany's going with number one. Send me the money. It's tax-free, better than a lottery check. Okay? But there's 4 other options. And we're going to talk about all 5 of them, hopefully in ways that make sense. Okay? Cash, beneficiary receives tax-free benefit. Go have a good time, Tiffany. Now, you can also take life income, which allows you to receive that $50,000 spread out in annual payments to you or monthly payments until you die. Now, if you're not old, this is not a very attractive option because it's 50,000 divided over 50 years. You're not getting much money, okay? But if you're 75, you might get a pretty good check because what they're doing is they're converting that money into a life annuity for you. Now, if you guys have studied annuities and you're comfortable with my words, great. If you're not, I haven't got time to explain annuities today. Okay, but it's a lifetime payment that you cannot outlive. You'll get money stretched out. You can take interest only. So Tiffany says, send me the interest every year and let me think about what I'm going to do what I want to do with the money. Now, the interest is taxable. The death benefit isn't. And you can't take interest forever. Eventually, you're going to have to tell the insurance company how you want to receive the money. The last 2, these are actually, if you've studied annuities, you're going to be a little bit comfortable with this. Tiffany says, I'm afraid of blowing the money. Can you pay me out the money over the next 5 years? Figure out the money plus interest. So after five years, I've received everything, but I've received it in chunks. Okay? She tells them how many years to give her the money. Or she can say, give me a fixed amount. I want $5,000 a year till the money runs out. And then you either tell them how long you want to receive it or how much you want it to receive, and they'll pay it out over that period of time. That lifetime payment is going to pay Tiffany until she dies. So there's 3 different ways to stretch the money out, plus there's interest. In fact, here's the 5. Cash that everyone takes, life income, pay until you die, interest only, pay me for a certain period of time, pay me a certain amount. 4 and 5 are until the money runs out. Okay? So what we've done here is we've broken down 3 different options that are in this chapter that you have to somehow get comfortable with. Non-forfeiture, you're cashing out a whole life. What do you want to do with that cash value? There's 3 options. Okay? Dividends, crapo. There's 6 ways to receive your dividend. And settlement options are in front of you. Now, truthfully, number 1 is the most common one in all of them. Cash, cash, cash. But you have to have some sort of walking familiarity with these other terms. So when you see them on a test, you don't go, I never heard of this before. I'm going to miss this question. At least have some sense about what sport you're playing. Okay, kind of get it as clear as you can in your mind. All right, I'm actually done. This is my commercial. If I make sense to you, if you think I teach in a way that's helpful, if you go on Insurance Exam Queen on YouTube, click on join, you can get all the classes taught by me for only 26 bucks. It's a subscription, you pay by the month. It's how I take care of the lovely Mrs. Lemieux, who's got high tastes. What can I say? But anyways, that's my commercial. I have another message for you from the Queen herself. Thank you for studying with us. Melissa and I'm interested in one thing. You guys pass the test, okay? She has developed a ton of stuff, very reasonably priced. All her packages, gold, silver, bronze packages, where she explains this stuff to you, are a bargain, okay? She has practice quizzes, practice tests, live classes like this that we teach, all kinds of things. We tutor, we mentor. We just want you guys to pass. So I want to thank all of you for coming. I hope I was helpful. Let us know how we can help you. Shoot us an email if there's something else we can do. So thank you all very much. And I'm going to be back tomorrow with another class. I don't remember what it's about. Oh, yeah, Medicare. I'm going to do Medicare tomorrow. So if I can help you, join up. I teach classes usually every week that are live. So thanks a lot. You guys have a great night. Good, Nikki. I'm glad to hear that. I think tomorrow is at noon. Let me just take a look. It depends on time zones, right? Tomorrow, um, it's at 12 o'clock Central, 1 o'clock Eastern, and it's going to be on Medicare. It's on the website, just like you found us today. It's up there. So thank you guys. Have a nice evening, and it was a pleasure being with you.